Life insurance needs analysis. Objectives of this lesson are that we should be able to discuss the costs associated with a premature death and determine a client's life insurance need by applying either of the following methods. First, the human life approach. Second, financial needs approach. Or last, the capital preservation approach. In general, life insurance is insurance that addresses the financial consequences that inevitably results from premature death. Premature death is defined as the death of a family head who leaves behind outstanding unfulfilled financial obligations, such as dependents to support, children to educate, and mortgages to pay off. What are the odds of premature death? Well, based on a study from 2004, The Changing Face of Mortality Risk in the United States, the risk of not reaching age 65, of dying at age 65 or sooner, for males is 1 out of 6. For females, 1 out of 9. Now, because of the increased chance of mortality for males, that's why the cost of life insurance for males is higher than for females at a given age. So, some of the costs of premature death include the breadwinner's lost earnings, additional expenses, such as the final expenses, funeral and burial expense, deceased uninsured medical bills, estate settlement costs, and federal estate taxes. It can result in a post-death reduction of standard of living, and also which will compound the emotional grief of the family and the time to adjust. And the financial impact of premature death differs between types of families. With single people, it's not significant other than the modest amount to pay for funeral and uninsured medical expenses. With single parent families, it is extremely significant because there is no second spouse to continue on in terms of income potential. So the death of a single parent can cause great financial insecurity for the surviving children. On two-income earner families, it could be significant as the lifestyle of most two-earner families is geared towards two incomes, and the loss of one of those incomes could significantly upset that lifestyle. And another thing about two-income families is that we lose the income of the first spouse who passed on, and the second spouse oftentimes will have to either quit their job or take an extended time off unpaid. So really the entire income goes away. So it's not about just replacing the first spouse's income, but actually replacing their own income so they can focus on the children and the emotional healing of the family. Next bullet point, traditional families where only one spouse works outside of the home. It is also extremely significant as the death of the breadwinner can cause great financial insecurity for the surviving spouse and children. The surviving spouse may not have marketable skills outside the home. Case in point, my most recent death claim is a traditional family. They have a stay-at-home mom for 12+ years who does not have any formal college education. The spouse who passed on at age 45 was earning over $150,000 a year as a software engineer. So they've gone from comfortable middle-class existence to no income. The life insurance they had was right about $1 million, so that's going to provide the transition there. But again, traditional families, it can be even more devastating than the two-income. On blended families, divorced or widowed spouse with children remarries to a new spouse with children. It could be significant because often both income styles are needed, or both incomes are needed to maintain the family's lifestyle. Sandwich families. This is when your parents move back in with you when you're in your 40s and you still have kids that you're raising and going to college. It is extremely significant because not only are we looking at just one generation, we have the cost of caring for the parents as well as the residual cost of caring for the children. In terms of determining needs, there are 3 approaches that are used in determining how much life insurance you need. The human life value approach, the needs approach, and the capital retention approach. On the human life calculation, it's fairly straightforward. We attempt to estimate the present value of the family's share of the deceased breadwinner's future income. So what we'll do is estimate the breadwinner's average annual earnings over their lifetime, deduct all income taxes, Social Security, other employment-related deductions, and costs of self-maintenance. So someone who's earning $80,000 a year, well, after taxes and self-maintenance, maybe $40,000 a year is the right number that the family would need. And then we take that result, deducting expenses from the annual earnings, what's left to support the family, determining the remaining number of years to retirement. So again, in this one, they started at $80,000, but we figured $40,000 after deducting for taxes and maintenance. And if the person was 37, currently, normal Social Security retirement age for that person would be 67. So we have 30 years. So we'd take the $40,000 a year times the 30 years, so 1.2 million, but then discount for net present value of that cash flow. And another example of that. And again, this is just what we talked about there. Now we have the needs approach. Analysis of various family needs that must be met if the breadwinner was to die. These include final expenses, readjustment period income, and dependency period income. Final expenses are fairly straightforward. The funeral expenses, uninsured medical, final debts, income, estate taxes, estate administration expenses, such as if there are probate fees or rewriting the will and trust for the surviving spouse after the first spouse died. The readjustment period income during the first couple of years after death. So if a surviving spouse wants to take off 2 or 3 years because they feel that's appropriate to focus on the kids and, again, help with the emotional healing of the family. Last being the dependency period income, the period following the readjustment period through the date when the youngest child reaches 18. Other family expenses that might be analyzed include life income needs of the surviving spouse, special needs, mortgage redemption, educational fund for the children, and an emergency fund for the family, and last would be the retirement needs. Again, we have other examples here. Paul has estimated his family need in terms of final expenses at $15,000, readjustment period income $30,000, dependency period income of $250,000, life income needs of the spouse at $150,000, and the special needs of paying off the mortgage, setting aside money for the child's education, and an emergency fund. And they also felt retirement needs are $0. So the following assets are available. We subtract those available assets from the gross need. So we have balance in checking, mutual funds and stocks, IRAs, and life insurance through the employer. And this is what we come up with. The total needs outlined 2 slides ago, plus the assets available in the prior slide, or excuse me, minus those, gives the net life need. So 580 minus 210 being 370. Last, we have the capital preservation approach. Under this approach, the capital needed to provide the income to the family is preserved. So you're living off the interest in essence. The amount of life insurance needed under this approach is determined by preparing a personal balance sheet, determining the amount of income producing capital, determine the income objective for the family, and determine additional capital needed using an assumed rate of return. So again, an example here, personal balance sheet. We have the assets on the left side, through those various sources coming up with a total of 470. We have the liabilities and net worth. So we see the liabilities of about 100,000, the net worth being the difference between the assets minus the liabilities. And so again, we take the total assets and in the left column, add up all the mortgage payoff, other liabilities, final expenses, etc. for the total deductions, and the capital is now available for income. So if his income objective is $40,000, his additional capital need is determined as follows. We have the income objective at top, less the capital available, $50,000 times 6%, to be $3,000. The estimated Social Security survivor's benefits of about $1,000 a month for his specific situation, which leaves us with an income shortage of $25. So the total new capital needed, assuming a return of 6%, would be the shortfall, $25,000 a year, divided by that 6% rate, so $416,000 and change. To summarize, we have reviewed the costs associated with premature death, and we've reviewed how to calculate a client's life insurance need by applying either of the following methods: the human life approach, the financial needs approach, and the capital preservation approach.